Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of The Options Playbook, and I will be your host for about the next 20 minutes here on Options Guide TV. All right, so on Monday, we went in and did a trade in Circle, and I'm going to start right there. So we're going to jump right into it. Here is the what if calculator inside the options in the options grid inside of Tradier Pro, and the what if calculator is what we're looking at here. And so we did a trade, and it was a very solid trade that we put together. And just once again, it was funny in that we did both sides of this trade because a little bit skeptic. The official paper trade in Circle was to get bullish, and I was leaning towards the bull side. And because volatilities were so high, butterflies were cheap, and that's almost always the case. Well, it is the case. When volatility is high, when you put on a butterfly, since you're selling two at-the-money option contracts, and they're just a little bit out, right? In our instance, when we put this trade on, they were a little bit out of the money. You're bringing in so much premium that you want that vol to be as high as possible. Now, Circle announced earnings once again in the crypto space, and the company has been doing really well. They blew all the numbers out the door. The stock, after a parabolic, moved up, and this is why I think we flipped the coin about being bullish or bearish, anticipating a good earnings, but worried about the sell-off. So the marketplace didn't sell off because of the earnings announcement. They ran the stock up. At one point in time, the stock was up 15%. So this butterfly, if you acted on it, you got out quickly. And by all means, when the market came down and was sitting right at 180, you 100% should have been out of the trade. There's no reason for it to let it drift this direction. The market at the high, so let's go pull up the chart now on Circle, CL. At the high, it hit 187 before it's closed down. And notice that this is a red candle. And I even think it was higher in the after hours, actually. So we go all the way back and look at the trading view 180. Well, let's send it. Here's where we are. We got to send it to the ticket. Here we go. And then that will take care of that. And as high as 187, so it came all the way up to here, was at a very high level. And then the market started it hung around there. It actually hung around 180 for quite some time, right in the middle of this. So you really should have. There's no reason for you to not get out at that point in time. But if you let it drift lower than 170, at 170, you definitely want to be out, right? Because you're at the precipice here of going down lower. And now it's at 156. Now, what I find amazing is that it's still trading for 56 cents. So we went 30 points down. We went from 187 all the way up here, all the way down to 156 on this trade. And that's, well, we'll call it 30 points. And this thing has still got enough juice into it to be trading for 58 cents. So I would get out. I would keep the juice. There's no reason. You obviously got a chip in a chair if you think it would come all the way back, but we paid $2 for this trade, and you can take 54 cents out of it or 60 cents if you've slept and you were not awake at all on the earnings announcement day, even though you did an earnings play. You would still get out of the trade. So if we go and we look at CRCL, the implied volatilities came down. Well, and the August is still very high. Well, mainly because the stock just dropped, right? Ridiculously. But it did come all the way down to the 80 level. And when we put the trade on, I'm going to look at, squint my eyes, 140 was about the implied volatility when we put it on for this expiration for the at-the-money option contract. And now we've came all the way down, and this is now trading at 93. So here's another reason why you should get out. is because this vol is 93 and it's not 80. And it should be going to more towards the historical volatility numbers. So I would anticipate that if the stock does bounce a little bit here and start coming back up, any gains that you get in delta are going to be offset by a volatility crunch. That makes sense? Another reason to just get out if you rode it all the way to the end. But I'm going to chalk this one up as a winner. When it hit 180, you should have been out for sure. You had less exposure to the upside than to the downside. Definitely a profitable trade. Wondering if there's anybody out there in webinar land that did the trade and put it on. And if you did, I hope you were watching it. And if you do, go ahead, share it. That's what this show is all about. We got an open discussion. Chat box is open. You got something you want to share with the group, share it. Let us know what's going on. And then if you did a trade and you did close it at the 180 level, then yeah, let's do that. Let's look at that trade and see what ended up happening on that position with you. I did not put the trade on personally, mainly because I actually had appointments on Thursday, so I wasn't around trading during the day. SPX got another winner on the SPX. So we got one loser and one winner on the SPX so far, and I'm going to keep with the theme. So we got a strong update today. Hints that, the Fed's going to be, I think what's driving it mainly is the inflationary numbers that came out. Some of the economic data has hinted that it makes it more feasible for the Fed to cut at this next event. So the probability of a rate cut has gone up a little bit, and I think the marketplace is playing off of that. And so we got the VIX down, which hurts our daily play trade. Now, time decay is time decay, but the issue is that if you do a one-day butterfly and volatilities are lower than they were on Monday when we did a one-day butterfly, you're going to pay more upfront. The potential to make $1 or $2, which I actually did the butterfly and I actually closed it out at 3 o'clock. And when I closed it out, the trade was up $2 at 3 o'clock. Put it on for, in our show, the butterfly was at 3:30. I think I put it on for 3 and I closed it out for 5 on that long butterfly. So if we're going to keep with the theme, we're going to do a butterfly for the next couple of weeks. As a matter of fact, I've already made the plans. I'm keeping the screenshots, and I'm going to put together, if we put it on, basically, I mean, they're not going to be at the perfect time to get out. But if we put it on during the show, like I mentioned, it's 11 o'clock. It's 11:10. Every second matters because it's 11:10. I'd rather put it on around 10:30. I'm not going to keep saying that over and over again, but a little bit earlier in the market, Eastern time, I would prefer to put it on. But we're going to put it on it wherever the direction of the market is at 11 o'clock. And then by 3 o'clock, we're going to be out of the trade. We don't want to be in at the last hour. Preferably, if we are profitable and it's around 2 o'clock, want to take the trade off. And we want to take whatever we can get at that point in time. I don't want to let the market go against you. The delta gets really high. Time decay is huge between 10 o'clock and 2 o'clock. So I prefer to just get out. If the market's kind of hanging around, the other day I took the trade off at 3 o'clock. But with that said, that's what my plan is. And then I'm going to show the results as part of the Labor Day Monday show. So we'll do a tape and I'll do a PowerPoint and I'll put the slides together. And we'll see how they did. So we'll do a Monday, Wednesday, Friday, 0 DTE, directional butterfly based off of where the market's at. So it will be an open wing butterfly. I just thought of that the other day. I thought that would be a lot of fun to put this together and try to put some rules behind it as to what we're going to do. Now, if you are doing this on your own, you would want to do them when you had an indicator or something that would, maybe something that happened in the chart. Maybe you broke down below the 8-day moving average or below the 20-day moving average. Something would happen to normally do a trade. You'd want to pick a reason to be directional. But with 0 DTE, your whole play is about theta and time decay. So SPX. Okay, so here if I go to the what if calculator, Oh, I had it and I didn't send it. Doggone it. Okay, so now I got to set it back up. So SPX 0 DTE, August 13th. We go 10 points wide. We center it around at the money. We're not quite at the money. So do we want, it's right in the middle. That's kind of annoying. Market always moves while I'm setting it up too. 64.52, right exactly in the middle of the strikes. That's annoying. Come on, tick. Go ahead and tick. And it's not moving. All right, let's sell the 55. Okay, so we'll buy this, but that might make it actually even more expensive. 1, 2, and then so that's 10 points wide, and then this is 5 points wide. 365. Okay, yeah, I don't mind that. We paid 330. Oh, we paid my screenshot says that was 12. That was later in the day. My screenshot says 310, but I think we paid 330 on the show. Right now it's 365, and volatility is off a little bit. So because volatility is down, because we have such a big up day, it's going to make it a little bit more expensive. All right, we're going to say 365. Print it. Here's the trade and send it to the what if calculator. We're going to be bullish on it. Obviously, the market is leaning bullish. We're going to stay bullish. And let's walk through it. So in this instance, market's down, trading right close to at the money. I'd really like it to be at the money. When we do it, I want to sell as much premium as possible. And I want it to be all-time premium, right? So if I could, I would almost, if I'm doing this live, if I'm doing this for my own account and it's not a paper trade, I'm going to wait until this either comes down to 64.52 or goes up to 64.55. I want to sell time premium, and I want to sell at the money time premium. Okay, so with that said, we're going to put this on right in the middle of the strike. We're going to pay 365 for it. If we can get out for, if you get out for 510, we're going to get out. We're going to take the trade off. You can say to yourself, you can let it run to the downside, but I'd prefer to take it off if we're down 50% on the trade. And ideally, that would be the way that I would look at it. I want to be able to make it about 50% of the trade on the upside, and I only want to lose about 50% of the trade on the downside. And then I'm also going to get out just based off of time. If we hit the 2 o'clock hour and we're not out anytime between the 2 and 3 o'clock hour, we want to get out in that range. We're putting on for 365. We'll take it off for 550 if we get that opportunity. The maximum that I can trade for is $10. And we never want to hit a home run on this because we're never going to ride it all the way to expiration. If we hit a home run, we get the money, but then we also get the stupid award for not getting out early. And I don't like getting the stupid award, but that is basically the way it works, just in general. So this is what we're going to do. Now, one of the things that I love about the SPX is that it is a cash settled index. So if we are doing this and it settles in cash, you can let it ride all the way to expiration. You don't have to worry about assignment risk. You don't have to worry about being assigned early. You don't have to worry about any of that. You can actually trade it. And I say this because that is the opposition to the SPY. The SPY, you do have all those issues with dealing with the stock because it is a settled in the stock and ETF, I guess. But in the SPX, it's settled in cash. And so there we are. We're down a little bit on it. 365 is going to be the number that I'm going to print, and we're going to ride that. And the market is now at 64.50. Yeah. So interesting enough, if we put it on now where the market was down by that level, I wonder what it may trade for. Let's go look at it. Let's move it. I'm going to keep, this is the paper trade. This is it. I'm not going to keep messing around, but I want to see at 50 what that would be. Let's move everything down 5 points. Buy, sell, buy. 385, $4. $64.50. We're paying $4. This is now $8 is our premium that we're selling, and it's trading close to $4. All right, here's our trade inside the what if calculator. No, that's the trade ticket. Let's send this one to the ticket. Oh, I didn't check the box. I'm sorry. That's why it's not going. So we're still even on the trade. All right, that's it. Any questions about the trade today? This is the only position that I have on. Now, I guess there isn't too many exciting things going on in earnings space this week. We got Cisco that's going to be announcing Wednesday after the close. Advanced Auto Parts has been doing really well, and they're announcing Thursday, and that's a fairly high price stock. Yeah, we're right at 11.20, but let's look at Advanced Auto Parts. It's one of those kind of surprising stocks that if you don't think about it, if you don't, it just doesn't get a lot of play on the financials because it's not a powerhouse. It's not a tech stock. So it's not part of the Make 7. So look at the move. Huge move up all the way back. We're sitting right on a precipice, right at this huge gap that came up, and we're right in the middle of it. Yeah, that's an interesting trade. And they're announcing Thursday before the open. Yeah, we could look at a skip strike, trying to sell something up here. It's all about the vol. What's the max vol we can get on it? This might not be a bad opportunity. I see it getting all the way up to that 70 level. I mean, that was a down day, but the high was 70. 4%. Yeah, we're probably looking somewhere around here, 65. Okay, let's look at it. AAPL. We'll make this an official paper trade. Something to look at, right, when we come back on Friday, August 15th. So you'll have 2 full days for this to trade, but it's not a bad scenario. So 1 standard deviation move, we're looking at 720 or so, right around the 20. Delta is 69. 720 is right around here. This is about the 1 standard deviation move, and vol is 180, but it's a $60 stock. Man, there just isn't a ton of premium in this right in here. You'd have to go 2 points wide. This is the same bid, almost the exact same price on these 2 option contracts. All right, let's see if we can get it done for this. With 2.5 points, 167. That's a 1 standard deviation, or the expected move away. Let's put this in. Let's go here. 705 based off of the midpoint of the long straddle with the stock right at $60.50. All right, we'll do this. So let's buy this one. I gotta clear it out. Buy this one, sell 2 of these, and this would be 70. So 72.50 would be the perfect skip. Might have to go to 73. 61. That's not too shabby. All right, we're going to have a little bit more because there's no 72.50, so we're adding an additional 50 cents worth of risk. Let's try 72. 44 cents with $200 of risk. Net credit. Oh, yeah, no. Okay, that's why. 75 buy. 70 would be, let's go 2 points this way. Let's do it this way. Let's go 67 to 69. Okay, so buy, sell 2. That's 68. We want to go 69. 67 buy, 69 sell 2. Okay, now we're 2 points wide. So now we need to go 4. 73 buy. 3 cent net credit. Okay, so if we go to 74. So you're doing $10 on $3 worth of risk if we can get this done for a 10-cent net credit. So 10 divided by 300, we're looking at about 0.3%. Usually our goal would be to get 4% on the trade. Let's leave it there. We're going to say we need a net credit of 11 cents to get to the account. If you do quite a few of these, this isn't bad. The expected move away is right at 69. If we look at the charts, 70 is the most recent high that we've seen on it. It's going to have a tough time breaking out beyond the 70 level in theory. And then we get hurt at 74, another 4 points higher. So basically right around between 71 and 72 is where you don't want the market to get. It's saying there's about a 15% chance of it getting to that range based off of this expiration date. We're bringing in about 3% of the total risk of the trade. It's now trading for 13 cents. I like that better, but we're going to say 11. That's our official paper trade. If you got it done for 15 cents right here, market's at 60.56. It's going to announce earnings at the end of the day. Wow, that's a big difference here. Maybe you put it in at, we're not moving. We started at 60.50. I don't know why this is jumping around so much. I think it's these bid asks. This one's a little bit wide. This is 25 cents wide. That's yeah. This one is the issue. But we're coming in as a four-legged or as a three-legged trade, 4 contracts. We should be able to fill somewhere towards the mid. Maybe you start at 20. I'm going to say it's 11. I'm okay with 11. 11 was 3%. I wasn't okay with it. I want to get at least 4% of the risk. But I don't mind this. I would work this one around 11 and put this in. And this will be the official paper trade. Well, I'm going to say 11 because we put the trade together at that, and that was legit. I would obviously work this around 20 if you're out there. You probably didn't hit the send button right at the second we were doing it, but I'd probably put that in at 20. And if I could get it for 20, I might actually even, I might try it. I might go put that trade in. There's a lot to, just from looking at the chart, it's an auto parts store. They can have great numbers. There's obviously volatility that's in the chart just from looking at the way the chart has been. And then let's go back even more days, 2000, and let's go 1500. I think that's too much. So right 90 was the highest point going all the way back to 2024. And then look at this breakdown right here. Yeah, it's going to have a tough time getting up over 80. Like it tried to fill the gap here and it didn't make it and it came back. Yeah, I even like to trade more by going further out in time and looking at the chart. Right here is the gap that I'm talking about. That's going to provide some resistance. And it did. So it came up and failed, and then it just hung out right here before it eventually dropped. And then it came up and touched that level again. Oh, no, it didn't quite. Right here is the level. And then it came up towards that 70 level. All right. I don't mind the trade. I don't mind it. Let's just leave it there. And that was off the cuff. Obviously, I did not plan on doing it. That's it for today's daily play. Let me go in and look at this. Let's look at the no questions. All right. That's it for today's Options Guy TV. We're going to do a daily play in the SPX, and we have that on right now. We're also going to look at, and we'll make this an official paper trade. We'll say this is a winner or a loser on Advanced Auto Parts. It's 35 cents right now. I like it. Man, that thing's jumping around, and the stock just isn't moving. But man, you get it done for a net credit of 20 cents. I like it. All right. I'm just going to let it go. All right. That's it. Thanks for stopping in. We'll see you Friday, 11 a.m. Eastern time for the next edition of Options Guy TV. See you then.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.